Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know you're going to get value from the gentleman we're interviewing today. In fact, we've never had an insurance broker on the show before. His name is Darrin Gross, and he's with Leonard Adams Insurance out of Portland, Oregon, and he focuses on real estate insurance. And so we're going to dig into what you should look for when you're getting insurance, the questions you should ask a broker, and things of that nature to help you with that piece of the business. Without further ado, Darrin, welcome to the show, buddy.
Hey, Rod, thanks for having me. Looking forward to our talk.
Absolutely. So I know you've got a portfolio as well. You started in single family, but why don't you talk about how you got in this business to start, and then we'll shift over to the insurance questions.
Sure. So back in the day, I started in insurance, and at the time I knew no one. I grew up back in Kansas, so I was a transplant to Oregon, and basically it was trying to survive, and write anything you could kind of thing. And along the way, answered the phone, and it was a guy that was buying some distressed single family properties, and he called, and then he called back, and he called back, and he called back, and every time he called, he had another property. And so I was always out there, taking pictures with my Polaroid camera, trying to shade the light just right so the underwriter wouldn't see the moss on the roof or the tree growing out of the fireplace, or whatever the problem was. And anyway, over time, I learned from him just the little bit about real estate, enough to make me curious. And I think at the time, I too was all I wanted was a new car. I wanted enough extra money for a new car payment. And he was telling me about how he made $100 a month at this one, $100 a month at that one, and I was going like, wow, that's what I need $100 a month here and there and there.
When was this?
Oh, this is back in late 90s. So, because what ended up happening actually with this customer, I was in the driveway of one. I said, man, I got to get into this, and he goes, you want to get in? I'll sell you this one. And I was like, but this is a real turd. I don't want this one. So anyway, he made me an offer, and I remember going home trying to run the numbers and couldn't make it work. But I remembered one thing. And that was that he needed $10,000 to go do his next deal. And I realized that if I took away the number he offered me and I focused on the $10,000, I could make it work. Anyway, I got into that property, and it kind of opened my eyes to real estate and investing. And since then, I've tried to focus on working with real estate investors, and we've accumulated. We've got 6 single families, and we bought a 12 unit apartment building here recently.
Okay. Well, you basically solved a problem, and guys, those of you listening, that's what this business is. It's problem solving, and sometimes the solution is not the price. Sometimes the solution is in this case, it was $10,000 for you. Sometimes it's timing. They need to sell right away, but you need to focus on solving the problem. And when you become a problem solver, you'll become successful in this business. So let's shift gears over to insurance. Okay. In fact, I just had one of my coaching clients ask me, he's ready to get insurance for a 50-ish unit property in Atlanta. What sorts of questions should he be asking an insurance broker? Well, actually, let's even go back a step. What should he look for in an insurance broker? What are the sorts of questions that he might ask the broker about them to find the right broker?
Sure. I think, with a broker, I think you're looking for experience in the market that you're working in. If it's a guy that only does manufacturing, or he only does home and auto, he may not fully understand the risk that you face. So I think I'd start with looking for a broker that at least knows the risk, and then also has access to markets.
When you say knows the risk, knows the asset class that you're trying to insure.
Correct.
Okay.
Correct, yeah.
Right. So you want a broker that does multifamily, bottom line.
Exactly.
Okay.
And then I think the other thing too, there's 2 types of insurance distribution models. One is your direct write, which is like your Farmers, Allstate, State Farm, where they represent one flavor, and that's the flavor. When you get into older, C-class properties and stuff, that may not be as good of a fit. The and that's where a broker can be a lot more helpful. Brokers represent companies from names you've heard of to, Lloyd's of London and everything in between.
Sure.
And, insurance is, the insurance company is not looking to buy a claim. And so as your properties are newer.
What do you mean by that statement? Could you expand on that statement?
Well, an underwriter's job is to avoid buying a claim. So when you present the information, the underwriter is going to look at it and say,
"Oh, I see what you mean. Sorry, I misunderstood you. Buy a claim. Yeah, they don't want claims, obviously.
Yeah, they're in business.
Okay, got it.
They're in business to collect premium.
Right.
They do pay claims, but the preference is just to collect premium, right?
Correct.
And so the things that I think that most of the investors I work with, especially newer investors, are probably starting off with C-class properties or looking for some sort of a value add play. I think knowing what's in, what an underwriter is going to look at is probably a good thing to start with. And if you have that
let's hold on. I want to come back to that. I'm sorry. I want to circle back to that for sure. But back to evaluating the broker that you're talking to. Would you suggest that you ask them if they've also underwritten or placed coverage on C-class properties, on older properties, as it were? If you're looking at a C-class 30-year-old property, wouldn't it be a good idea to make sure that they're familiar with writing coverage on a property like that?
Absolutely. And it goes back to, like you first mentioned, solving the problem.
Right.
I think in an insurance broker that solved problems and understands the problem is going to be answer that affirmatively and give you the confidence that they know what they're doing.
Right.
Depending on the market you're in, if you're in some smaller market, the guy might write everything from A to Z and not have a specialty. But if you get into more of a metro area where there is more specialization, I think you're probably more likely to find a broker who has experience. So you ask them, what their experience is with multifamily. Ask them what carriers they represent. If they only list one company, you might ask, well, aren't you a broker? I thought that was the whole idea of, brokers have multiple companies to go to, and just kind of feel them out. But I think that you start with, I would say basically experience is what you're looking for.
Okay. And I will tell you guys, the best way to find any team member, and really insurance broker is a team member, the best way to find any team member in this business, this exciting business that we're in, is through referrals. Right. You ask real estate brokers, who are the insurance brokers you like. You ask property managers who are the insurance brokers you like, and that's how you find the people. Particularly, obviously, you're going to want to ask brokers that specialize in the type and size and class of property that you're buying, because they're going to know who the insurance brokers are, because they're doing closings in that type. You're going to ask property managers that manage that type of asset class. If it's a C property, find property managers that manage those kinds of properties and find out who they use. And that's one of the best ways. So let's talk about types of coverage. Actually, let's go back to your conversation about you were talking about starting to talk about due diligence as you're looking at an insurance, as you're looking at a property as it relates to insurance. So maybe you could expand on that a little bit.
Sure. Well, and the first thing I would say is you're building your team out, make sure you have the broker you've identified, or maybe a couple of brokers to get a feel for it if it's your first. But do not wait to contact your broker when you've identified a property. Insurance
broker, guys. We're talking insurance now. Again, we're on insurance brokers. I know it's easy to get confused.
Thanks for the clarification. Yeah, if you put in a letter of intent and it's accepted, that's the time to get your insurance broker engaged ASAP. Because while many things you can get a quote on the day you speak with the insurance broker on, if it's a more involved property and it has more of a story and there's fewer underwriters that are willing to take a look at it, there's going to need to be a little bit more time. There's going to be some questions that need to be answered. And so I would say first things first, give your insurance broker plenty of time.
Okay.
And then from there, I think the four things that the insurance companies tend to focus on, and I think these are universal, but I would say the four systems that are of most concern to an insurance company. Start with the roof, the age and condition of the roof. Then they start looking at your plumbing, age and condition of the plumbing. age and condition of the electrical system, and then age and condition of the heating and ventilation.
Okay.
And then from there, it's, how well does it take a picture? I mean, does the picture look pretty scary, or is it something, because, the thing that everybody has now on their desk is Google Earth, and when they drive by and they look at it, and it's, there's trash everywhere, and a bunch of broke down cars and boarded up windows, you're not going to get too far with an underwriter. So, be aware of that when you're doing your due diligence. Beyond that, then I think if you, when you're walking the grounds and you understand the property, is what's the condition of the walk-in surfaces? Are the steps, are they secure? Are the railings secure? Is there a bunch of cracks in the
there's you've got to look at liability. Sorry to interrupt. And I just didn't want to forget this. If you've got sidewalks that have heaved and you've got, 2 or 3 inch lip from one slab to another slab, that's a tripping hazard, and that's a liability issue. And that's a professional tenant. When I say professional tenant, a professional litigating tenant's, wet dream, is to have something like that they can lay on the ground, have somebody take a picture of them and say they fell and hurt themselves. So, those are the kinds of things when you're evaluating the property, like you said, a loose rail on a loose handrail, things like that a professional tenant can capitalize on. When I say professional, it's a negative connotation in this regard. Okay. So you're looking at safety issues as well. So you're looking at the roof, you're looking at the plumbing, electrical, all things you're going to look at anyway, HVAC, age and condition. But of course you're going to look at the building structure. You're going to look and see if there's any structural issues. And guys, do not do your due diligence without a building inspector ever. I've owned thousands of doors, and I always bring a building inspector. If you're a general contractor, bring a building inspector. I would never try to do it yourself. But okay. So you're looking at these things.
Yeah. And then from there on the railings, I think there's a lot of buzz about the horizontal railings as opposed to the vertical railings, and how, what's the gap between the railings, and there are some companies that are more forgiving on that. But if you're dealing with an older property to begin with, just understand that the pool of companies that are wanting to write your risk is less than if you're dealing with a newer property that's only 20 years old. Okay, where the systems aren't worn out. And there's in the insurance company's mind, there's less chance of a claim on a newer property. Now, that's not necessarily always true. There's a big debate on whether or not fire suppression systems, the sprinkler systems in the newer towers and stuff are more of a claim ready to, happen, or if they're actually, clearly they'll put the fire out, but in the meantime, if they go off, accidentally or whatever, they can cause a lot of water damage as well. But that's a whole other.
And when they go off, they're going to cause a lot of water damage, and maybe excessive relating to the fire as well. Yeah, that's a valid point. So, okay, so when you're, so we've talked about identifying a broker through experience in the asset class and type that you're interested in, and through referrals. We talked about the things you do when you look at the property, the things you think about. We talked about getting started right away. What other things are relative in this insurance conversation to someone that's, buying their first multifamily, or any other things that we should be talking about?
Well, I think just to, again, on the due diligence thing, is just recognizing that, and I'm sure you talk with your listeners and investors about this, is that don't use the seller's number as your insurance. There's plenty of properties I've seen where the sellers own the property forever. Their agent has just always renewed it at the same limit. They may be going without coverage. They may have, they're like in Florida, I've seen multiple older properties where the guy's owned it forever and he's not worried about wind.
Right.
There's a little thing called hurricanes down where you are. So
yeah, we've heard about those.
Yeah. And when they happen, they can cause a lot of damage, and insurance companies know that, and they charge for that, a lot more than they do the other things. So I think, just to sum up that kind of due diligence thing is make sure you're having a conversation, and that you're you're able to provide all of the information, the square footage of the building, the number of units, all of those things are going to go into the underwriting and the application that the broker has to prepare, the insurance broker has to prepare in order to get you a quote.
Right. Now, I know you've done portfolios as large as 2,000 doors. So, I didn't speak to your credibility in this space, and I should have right out of the gate. So, this is valuable advice. Now, do we need to have a conversation about types of coverage? Can we speak to that a little bit?
Yeah, no, I think that's obviously, it's the reason you're buying it. And I think, the thing that I have to always remind myself is that, as many times it's the bank that's pushing the requirement. If you're going to borrow money, the bank's going to say, who's your insurance? We require insurance. There's still a risk to the investor, and you are, the broker, the insurance broker is providing protection to both the investor and the bank. And you're buying it so that you can minimize or transfer potential loss to the insurance company. So the thing that I always like to start with is the valuation. When you're focused on buying a property, typically I find investors are focused on, well, I can buy that for, 20 a door or 30 a door, or it's always a door price kind of thing. And I'll caution you, because if you get into a conversation with somebody that's in a different part of the world and you're buying a property in an area that they're not from, that number doesn't translate in insurance. Insurance is very regionalized. Where you're at with the wind and the hurricanes, it's going to be considerably more than where I'm at in the Northwest, where we have rain. Okay.
I'm not sure I'm tracking the conversation. Where's the concern? Help me out here.
Well, and I'm just saying in general, if you're listening to a podcast and, somebody's talking about how much they pay per door for, when they're buying a property.
Right.
And so let's say that the purchase price is $1 million, right? Okay. For the property. But when you do the replacement cost estimate, which is what insurance is based on, the contract says we're going to rebuild your property if these things happen.
Right.
Okay. That's based on what's going to cost to build back. Okay. Market price does not always equal replacement cost.
Okay. That's where you were going with this. Okay. Yeah. Got it. Okay. Yeah, sure. No question. So you want replacement cost coverage. Are there any other coverages, that should be discussed? And let's have the deductible conversation as well.
Sure. Well, staying with just the valuation, I always recommend that you have your insurance broker do a replacement cost estimate.
Okay.
Because it's really easy to, look at what the seller's numbers are. He's got it insured for this amount. Let's just insure it for that amount, but the reality is if you underinsure it, you're going to be disappointed when you have a claim, because you're not going to get the amount.
Well, the bank's not going to allow you to underinsure it too much anyway. Correct?
Typically, they're, and again, if you're if you're getting a good deal and they're only insuring, or they're only lending against that, that purchase price at say 70%, but the replacement cost of the property is twice what you're paying for it. The bank is typically looking for, and again, I think the banks are getting better about this, about making certain that it's insured for replacement costs. But if you're dealing with a less sophisticated bank, they're still looking for their loan to be covered.
Okay. So the bottom line here, guys, is don't underinsure. It's not that much more to get enough coverage that you need in case of a real problem. And I've had numerous fires in my property. Some have been complete teardowns in the past. And
but just on the valuation thing, and I don't want to just beat a dead horse, but here are a couple of things I'll give your listeners to make sure that they're asking for. So replacement costs, we've already covered that. If they've got a large schedule, they're not going to be on a business owner policy, which is a kind of more of a smaller policy or smaller property policy. But on a larger one, you want to make sure you're getting agreed amount coverage. And the reason why you want this is it eliminates any kind of a co-insurance penalty. Okay. Now,
gotcha. Okay.
The co-insurance is this dirty little phrase in insurance that basically says at the time of loss, the insurance company takes a look at how much you insured the building for versus what the co-insurance clause on the policy required. Okay. So just in a simple example, if you insured it for $1 million, right?
Mm-hmm.
And your replacement cost estimate, or excuse me, your replacement cost estimate is actually a $2 million building. You've only insured to 50%. Okay.
Okay.
And in the claim, if you have a partial loss, which is probably more likely on a $1 million building, you won't get the full amount. You'll only get 50% of.
Oh, no kidding. Wow.
Yeah. Yeah.
Okay.
So that's real.
Okay.
And trust me, the more zeros there are on the check that the insurance company has to write, the more they're going to look at the policy to determine how much do they owe.
The thing you want is agreed. You want
It's called an agreed amount endorsement.
Agreed amount endorsement.
Right. And this waives the coinsurance penalty.
Okay.
Okay. And it's an annual endorsement, and requires a statement of value between you, the buyer, the insurance buyer, and the insurance company, where they both agree that this is the value, so that at the time of loss, there's no coinsurance penalty applicable.
Okay.
So
any other endorsements? Thank you for that. Any other endorsements that someone may want to consider in the multifamily space?
If you've got multiple buildings, multiple complexes, I would certainly encourage looking at blanket limits. If you depending on how you're set up, we typically try and do a portfolio policy as opposed to a policy per property. And if you do that, you can get a blanket limit for all of.
And there are big savings doing it that way, correct?
I don't know. There's big savings as much as you are protecting yourself from any downside. If there was like out here in the Northwest, we have earthquakes, or especially down there where you're at with hurricanes. If you have widespread loss and all of a sudden the cost of materials and labor goes way up, right?
Right.
You could take from that blanket limit and apply it to whatever the damaged properties are, as opposed to being limited to just the limit on that one building.
Oh, I see. It's a bigger limit, bottom line.
Correct. Yeah.
Okay.
Correct.
Okay. All right.
And let me just give you one other thing here quick. On loss of rents, if you have a fire, you're not able to collect rent, right? Mm-hmm. The policy comes with business interruption or loss of rents. On many policies, they give you what they call actual loss sustained. There's usually a cap if you have that for 12 months. Based on the phase we're in right now, where there's lots of construction going on and labor shortage, and whatever the permitting process can be.
Sure. It could take a long time. Yeah.
It could take a lot longer. So certainly look for 18 to 24 months. In some cases, you can even get 36 months, depending on how large your property is. So those are some simple things.
Oh, that's huge. That's huge. So you asked for 24 to 36 months in really business interruption loss.
If you can get it, I'm just saying, I don't think 12 months is long enough in many cases.
Agreed.
And it's more of just the supply and demand, and then also the permitting. You've got to tear down what was damaged. You got to go through the permitting process. If they're backed up because they've got a bunch of new construction going on, it could be 3 months before you get your permits, and then you got to make sure that the construction crews are lined up to go when you're ready to go, and on it goes.
This is huge, guys. And let me tell you why this is huge, because you guys, there's something called mortgage payments. And if you have your building halfway burned down and it takes longer than a year, and you've only got business interruption coverage for a year, you could very easily lose the property, and your investors lose their money, or you lose all your money. So it's a really big deal. So that's a good one.
Right.
Okay.
And then just to touch on, we were talking about the trip and fall kind of thing. I think umbrellas right now are something every investor should have.
Umbrella liability coverage.
Correct.
Yes,
so
agreed.
It basically extends your, most policies come with like $1 million limit of liability for any bodily injury or property damage that you're responsible for to others. You can buy umbrellas, $5 million for really cheap right now. And
it's a no-brainer, guys. It's a no-brainer. Yeah, as part of your asset protection strategy, your property's owned in individual LLCs, and and all the things along that conversation. An umbrella liability policy is a must-have if you're going to be long-term successful. It's just it's you're crazy not to do it for the inexpensive amount of money that it costs. Okay. let's see, we've talked about types of coverage, replacement. We've talked about the endorsements. We've talked about, okay, is there anything else insurance related that you might be able to chat about that could add value to my multifamily investors?
Other than the fact that claims happen, I mean,
Right.
I think that, every policy I sell, I hope you never have to use it.
Right.
And that's not because it doesn't work. It's just when you have it, you've got deductibles. I mean, we talked a little bit about, deductibles. That's even when you have a claim, there's coverage, but you have the first, at least on the property side of things, the first dollars are out of your pocket. So whether you've got, $5,000 or a $10,000 deductible, that's going to come out of your pocket. And we are seeing, especially with the larger property schedules and syndications and that, people are going with higher deductibles. So if you're in any kind of like a wind zone like you're in, or flood zone, we're out here where we're at with earthquake, you have percentage deductibles, and those are not, a fixed dollar amount. They're a percentage of the limit. So if you got $1 million building and you got a 5% limit, you've got
5% deductible on that. Yeah. On that percentage. Yeah. We have that here with wind and flood, and it's painful when it happens. Ask me how I know.
Yeah.
I had 360 damaged properties when Charlie hit in Port Charlotte, Florida here. And, a couple of hundred, actually about 100 were uninhabitable. It was it was insane time of my life. But, yeah, and thank God I had good insurance, and thank God I did, even though I still ended up having to fight the insurance company. But thank God I had good insurance.
Well, and again, the deductible, I think a lot of times people look at it for a way to save money, which clearly the more risk you take on, the more you can save. But don't be penny wise and pound foolish. If you don't have the resources to pay that deductible, you'd probably be a little better off to transfer that risk and take the lower deductible.
Yeah, I couldn't agree more. Okay. Well, listen, Darrin, you've added a ton of value today that again, that we don't normally cover. And I know that, I know you insure lots of different asset classes, but, as well as multifamily. And, but guys, he's giving you some great advice, on this part of the business. That's a critical part of the business to protect your assets. So thanks for being on the show, my friend.
Thank you, Rod.
Absolutely. All right. We'll talk again soon. I'm sure actually you're coming to visit, so we'll have lunch here soon. So looking forward to that.
Looking forward to it.
All right. Thanks. Take care.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.